Hello guys, in this video we are going to see about transfer pricing and for what purpose we are using transfer pricing. If anyone not yet subscribed our channel, kindly subscribe, bookmark. Consider a company which is multi-divisional company. In this example, we are considering only two divisions. One is production division and another one is marketing division. In general, production division and marketing division comes under single company only. In general, we think that production division produce the product and transfer to the marketing division. Then marketing division will sell the product by marketing. But in transfer pricing, production division sell the product which has been produced to marketing division. This is known as transfer pricing. Transferring the product from one division to another division with some price is known as transfer pricing. Okay, why we need to do like this? To reduce tax. To reduce tax. So this process is known as transfer pricing. The purpose of doing transfer pricing is to reduce the tax. Okay. The question is, by transferring from production division to marketing division, how the tax is going to be reduced? If overall profit is shown in a single company, then tax slab will be high. By making the transfer pricing production division and marketing division, that profit will be splitted into two sides. Okay, production division will have its own profit and marketing division will have the own profit. By making this, the profit is split into two parts so that this tax slab will be low for the production division and marketing division. So some taxes will be saved. If overall profit is shown in single company, tax slab will be high. By making this, that profit will be divided into two so that tax slab will be low for production division and marketing division, so tax is saved. Production division has its own investment, own returns and own risk. Likewise, marketing division also having its own investment and own returns. Okay, this is not only the method of transfer pricing. One more method is there. Consider there is a parent company in India and another subsidiary company, subsidy of this parent company in Singapore. If you are transferring the product from parent company to subsidiary company, is also known as transfer pricing. Okay. Transfer pricing refers to pricing of goods and service within multi-divisional, as I said, multi-divisional company. Otherwise, cross-border transaction, parent company to subsidiary, India to Singapore. Okay. In case of multi-divisional company, in charge of their own profit, each division has their own profit and own responsible for return on investment capital. Okay. These examples we see now. Okay. Next, role of administrative and regulation and guidelines. They are fixing some guidelines in transfer pricing in order to avoid some irregulations. Okay. So this is done by OECD, Organization for Economic Cooperation and Development. Okay, most of the profit made in country, the transfer pricing purpose is to make the low tax by shifting the profit to reduce overall tax paid. By shifting within the multinational group, by shifting the profit, by making transfer pricing, we are shifting the profit so we can able to reduce the tax. And one more thing they said is protection against double taxation. In India, there is a parent company. Airlsafe, they paid some tax in production. After transferring to Singapore or a subsidiary company, they should not pay any tax there in Singapore. Okay, already they paid tax here. Once again, they can't able to pay in Singapore. So to avoid double taxation, okay, these are the two main reasons for regulation and guidelines in transfer pricing. Okay, how they are going to regulate? By using arm length price. Okay, what is mean by arm length price? Arm length price is a price at which two unrelated and non-disparate parties would agree to do transaction. Suppose a production division and marketing division comes under in a single company. Suppose company A of production division transferring the product to company B of marketing division. Okay, these two are different company. Okay, two unrelated and non-disparate parties. These are two unrelated company. If they are making some transaction, they will do at only in a reasonable price only. They are not going to make any irregulation. Okay, if they are making some transfer, some sale or some transfer, it will be in correct price only. So this is known as arm length price. Okay, that transfer pricing should be equal to the arm length price. Okay, this is for arm length price guidelines given by OECD. Okay, there are two methods to find arm length price. One is traditional method and another one is non-traditional method. In traditional method, there are three types. First one is comparable uncontrolled price method. Consider company A. This is a parent company, and then company B. This is subsidiary company. Company B is subsidiary to company A. Okay, and one more side, company A. This is company C. A and C has no relation. Suppose if company A making some transaction with company B, company A has the control over the company B since it is a subsidiary of company A. So if they are making some transaction, this is called controlled transaction. Because A can control company B, company A can control company B. But in case of A and C, these two companies are unrelated. So this is known as uncontrolled transaction. Company A can't control over company C. Now we are comparing these two. So comparable uncontrolled price method compares the price at which controlled transaction is conducted to the price at which comparable uncontrolled transaction. Okay, one is controlled transaction and another one is uncontrolled transaction. We are checking the difference between these two price. By checking that, we can able to find out the arm length price. And next one is cost plus method. In general, cost plus method is only used for finished goods. Okay, finished goods. So goods are manufactured at marketing site only. Sorry, at a manufacturing. Goods are produced in manufacturing. Then these goods will be sold to some wholesale dealer. or we can call retail distributor. Okay, goods are produced in manufacturing site, then by adding some amount to that production cost, we are sell it to the wholesale or retail distributor. Okay, generally used in finished goods by adding an appropriate markup cost. We are adding some cost to the manufacturing cost and then selling to the wholesale or retailer. Okay, for example, arm length price for transaction involved sale of finished goods related distributor by adding an appropriate markup cost. Okay, so at what price that wholesale dealer will get is known as arm length price. Okay, in general, transfer pricing means we are transferring goods from one place to another. At what price we are transferring is known as transfer pricing. Here we are transferring goods from manufacturer to wholesale dealer or retail distributor by adding some profit. So at what price that wholesale dealer will get is known as arm length price or transfer pricing method. And next one, resale price method. What is resale? That wholesale dealer purchase the goods from manufacturer, then he going to resell. He will sell again to the retail seller or third party. Okay, that product wholesale dealer or retail seller, retail distributor sell that product to retail seller or third party. Okay, so if in point of third party, if third party need to find out what is arm length price, you have to act in reverse direction, backward direction. So at some amount that retail seller will get the product by subtracting some amount, some price. He can able to figure at what price that wholesale dealer will get. Okay, already we said at price what wholesale dealer has is known as transfer pricing or arm length price. Okay, resale price is similar to cost plus method, but only difference is working in backward direction. Okay, in cost plus we are adding some amount, then we are finding arm length price. In resale price, by subtracting backward, here forward, here backward, by subtracting we are find out what is wholesale dealer price, working backward from the transaction. Okay, from the next receipt by subtracting an appropriate gross markup. So from third party point of view is subtracting some amount, so you can able to find out at what price wholesale dealer has got. From sale price to unrelated third party. Okay, distributor sold the product received from the manufacturer to the third party retail. Cost plus and resale price method are both are used for the same purpose, to examine the arm length price. Ultimate aim is we have to find at what rate wholesale dealer will get the product. In cost plus we are finding out the price by forward direction by adding. In resale price we are going backward direction by subtracting. Next we are going to see about non-traditional method. In non-traditional method there are two types. One is profit split and another one is transactional net margin method. Generally, profit split method is only used in examined transaction like research. There only we are going to use this profit split method. Here, the profit will be split based on the level of the contribution. Suppose company A sub is doing some research, is already having 7 researchers, 7 scientists. Company A sub need 3 more scientists. So they are requesting company A to provide some manpower. So company A provides some 3 scientists for the research. So totally 10 members. If they are making some research means for that research they are getting some profit 100%. Then this 100% will be split based on the level of the contribution. Company A will get 30% and company A sub will get 70%, because totally 10 members, each member will get 10% profit. Company A 3 members, so 30%. Company A sub is having 7 members, so 70% profit. So based on the level of the contribution, that profit will be split. So company A will get 30%. Next one, transactional net margin method. Okay, so this is an unified version of resale price and cost plus. So in this method, both RP and CP will be clubbed together. It means from manufacturer it will be sold to a retail distributor or wholesale dealer, then he will sell to retail seller or third party. Okay, so what will be the overall margin? This is known as transactional net margin. Total net what margin you will get. So unified version of cost plus and resale price. Finally, that transfer pricing is using in banking also. So some branch will have surplus fund, some branch will have deficit fund. So in this case, you will transfer the surplus fund to the deficit fund branch. So in general, the purpose of transfer pricing is to reduce the tax. They are providing some guidelines in transfer pricing, which is based on arm length price. Arm length price as in 2 method, one is traditional and another one is non-traditional. Okay. Thank you for watching video. If anyone not yet subscribed our channel, kindly subscribe, bookmark.